Welcome back to Money Media. James here, and today I want to talk about our economy, our Australian economy, and where it's at currently. Now, I've been a little bit inspired recently to create a video like this, of this nature, to give you a true reflection of where our economy is as of the 6th of February, 2025. And I think it's important because at the moment we are entering a political cycle where information about our economy is beginning to be delivered by different news platforms differently, depending on which side of the political landscape that particular news platform sits with. And so I'm obviously not going to name names or which associations they have with the political affiliations, but I think it's really important to have a clear understanding of where our economy is, so that if come time for you to vote for your preferred politician, whoever that may be, that you have an accurate picture of how well they have either done if they're the incumbent, or how well you think they might do, or how much better they might do than the incumbent. So I wanted to talk to this today. Here at Money Media, none of us have any political affiliation. I'm an economist, and so my limitation also is that I'm only going to be covering the health and state of the current economy. So the politicians are tasked with many jobs in our current day, many jobs, spanning many sectors, and economics and the economy is only one of those responsibilities that they have. So I just want to point that out. Although I'll get to the end of this discussion today, it's only covering that one narrow focus of the economy. And so as I talk through this as well, I'm also going to be posting up graphs of exactly what I'm talking about. And what I've gone and done with these graphs is I've gone through and I've set them all as bar graphs, and they're broken. Each bar is broken into either a quarter or a year, depending on the information that I'm providing. And what I've done for each graph is I've made each bar yellow for when the incumbent government, the current government, started their term. And hopefully that will give you an understanding of how these different measurements of the economy have been trending since they started and where they currently are now. So what I'm basically trying to do is give you all the tools to make a decision for yourself. So we're going to get started. And to start off with, I'm going to cover inflation. And I'm going to cover inflation first because it's probably one of the most important things and one of the most commonly discussed metrics in the media at the moment. So we've heard a lot recently about the RBA is reluctant to bring the cash rate down, and that's because the inflation is too high and it's outside their target band of the within 2 to 3% that the Reserve Bank of Australia aim for each and every year and each and every quarter within that year. So what you'll see on screen either now or shortly is a bar graph of, and you'll see the yellow bar indicating when our current government took over. So as you can see from quite clearly, year 2020 was that little orange negative inflation bar. It's very small, and it's about halfway through that graph. And so from there, you'll see inflation begin to tick upwards pretty dramatically. And now the reason for that highlights what inflation essentially means. So generally speaking, and simplified broadly, inflation measures the value of a currency. So the more of that currency exists in that economy, the more inflation is likely to increase. Now, if you can recall, during COVID, a lot of money was printed and injected into our economy. And so you can see that graphically.
Yes.
Because it has caused significant inflation, or inflation to increase significantly from the time of that money printing, which is essentially the year 2020, which is when that orange bar graph where that orange bar graph sits. So from there, we've printed a whole lot of money, inflation's naturally gone up, and that's what we'd expect to see. The incumbent government has come in and taken office at the yellow bar, and you'll see inflation has continued to go up slightly from there, which it naturally would, and you would naturally expect that. And they've managed to turn that inflation around and bring it down consistently since early 2023. Now, where we're currently sitting at, we are currently sitting at an annual inflation rate of 2.4%. Now, you may have heard a figure in the media of 3.4%. And what that 3.4% refers to is the underlying inflation rate, which is a trimmed and meaned version of inflation. So it's essentially a refined version, we'll call it. It's a refined version of inflation. But the annualized figure of inflation currently is sitting at 2.4%, which is within target range for the Reserve Bank. It's important to note too, I've just placed a little note on the graph that you'll see, but there has actually been more than a 60% reduction in inflation since the current government took over office. And so the next metric I'm going to be talking about is the cash rate, which is what the RBA sets. And some of you may understand this as the interest rate, which is actually what the commercial bank sets, which is what your home loan is repayment is determined by. Starts with the cash rate, and the cash rate is what the RBA sets. And so I want to run through quickly what a cash rate is for, why we use it, and then I want to give you a snapshot of where we are currently within the Australian economy. So the cash rate is used, it's the only tool that's used by the RBA to control the level of inflation within the economy. And that's why the cash rate's really important, because it sets the cost of money. So the current cash rate is at 4.35%, which is set by the RBA. And now they've kept it stagnant for a little while now. And we're due for the next announcement in about 10 days or so from the RBA. And they'll give us an update of what they're doing with the cash rate. So since the current government has taken over office, the RBA has essentially increased their cash rate just slightly more than 5 times, or 500%. It sounds like a lot. It is a lot, but it is coming off a very low base. And now I want to point out something, because actually zoom out of our, this graph I won't provide because I'm only giving you a 10-year snapshot. But if you are to zoom out to the 14-year mark, you'll actually see that the cash rate 14 years ago was about this rate. And at that time, the cash rate was the lowest it had been for years. And this is an important thing to point out, because a lot of people are talking about the cash rate where it currently is as a very negative thing. And so I want to clear this up. Our stock markets and our housing market in Australia show a strong economy. If our economy wasn't strong, then the Reserve Bank of Australia would be reducing the cash rate. Because if you remember what I said earlier with regard to inflation, when the RBA is trying to encourage spending and kickstart the economy, they want to lower the cash rate. So people and companies are more motivated to take loans. So the fact that the cash rate is where it's at, it might not seem like a good metric or a good sign of where the economy is at, but it's actually quite a bullish sign. It shows that people are confident enough in the Australian economy that they can't reduce the cash rate for fear of inflation increasing, because people would continue to take out lines of credit to invest those lines of credit. So while this may seem counterintuitive, the cash rate where it is at is actually a fairly healthy cash rate. And now I'm sure there's going to be pushback on this point, and I'm happy for you to leave comments in the comment section, and I would love to address those. But the cash rate sitting where it is right now isn't a negative thing. The negative part of the cash rate of where it is right now is those mum and dad investors who may have taken on larger loans than what they probably should have during the COVID period, where the cash rate was in my opinion, irresponsibly low. And so now they're having to deal with the burden of an increased interest rate because the cash rate has increased so significantly. And in this scenario, I don't blame the mum and dad investor at all. I think there's always some due diligence that needs to be done by anybody buying any sort of investment, absolutely. But I also think the banks, the banking sector, have an extremely large responsibility in how they offer lines of credit and to who, and with what buffers they create when they're deciding on issuing or not these lines of credit. So I think that's the main concern with the cash rate. Now, what we're hearing about, the frustration that the Australian people are having with their repayments is obviously well-founded, but the cash rate where it is right now is actually not an unhealthy level of cash rate. So I hope that all makes sense. I'm going to continue moving forward. The point I want to make is unemployment. Now, this is something I don't need to generally explain. Most people will understand pretty quickly what unemployment is, but I'll briefly outline it. Unemployment is a figure that measures within Australia all the people within the working population who would like a job, and out of that group of people, who actually has one. So our unemployment rate is 4%. And what that means is for everybody in the economy of working age who wants a job, out of 100 of that cohort, only 4 people don't have a job. And out of that 100, 4 people are looking for a job. So 96 out of that 100 are employed. That's a really positive unemployment figure. Very positive. And if you look on the graph, you'll see that it's trended down quite significantly, especially over the last 10 years and going back even further outside of this graph. Now you'll see it's starting to slowly tick up, which is the government trying to increase a little bit of unemployment just to take the edge off that inflation. Let's say if the unemployment was at 0%, so out of 100 people, all 100 had a job, that would be a negative influence on inflation, i.e. that would be putting pressure on inflation to increase. So where it's at right now is actually a very good spot. And looking through the data that I was able to attain, this government in current office have actually achieved the lowest unemployment rate in history of the data collection. So that's actually an amazing position to be in. And so moving on, the next metric we're going to discuss is the level of government spending as a percentage of the GDP of the country. Now, I don't want to get too technical with this. I know it may come across a little bit complex, but I want to break it down really simply for you. So GDP is gross domestic product, and it's essentially what it means is how much money comes into the country each year. So government spending as a percentage of GDP. Government spending is fairly self-explaining how much the government spends. So government spending as a percentage of GDP, if we were to break this down in an analogy, let's say that your salary that came into your household was GDP, and how much you spent of that salary is the same as the government spending. So you could imagine in your scenario, if you had $100,000 in salary coming in and you spent of that $100,000, you spent $80,000. So your spending as a percentage of your salary would be 80%. In this scenario is no different. So now that we've gone through that analogy, we can see here through the graph that since taking office, the current government has actually reduced the government spending by 15%. And they've kept it fairly stable throughout their time in office. And so where they currently have it sitting now, or during the tenure of the current government holding office, they've had it on average at about 25% mark, or 25% of GDP, which going back the last 50 years is about the average of where government spending should be as a percentage of that GDP. Wages growth, one that affects most of us. And now wages growth, another simple one, but I'll run through it quickly, is essentially how much additional growth the average worker is having additionally on their current wage. Makes sense, right? Looking through the data, you can see here, and I've made a note on the graph itself, where the current government has actually managed to increase the wages growth on average by 3.5% each quarter. And now this may initially look pretty good and sound pretty good. And while it's all right, it's not amazing. And the reason why it's not amazing is because inflation was quite high. So this is one of those counterintuitive ones that on a graph looks quite good. But I would say in real terms that wages haven't actually increased. I don't think they've decreased, but they've definitely, I wouldn't say have increased, but I would say at best they may have marginally increased against the rate of inflation. So it looks good on a graph, but it's remained fairly steady. Moving on to GDP. Now I touched on this a couple of metrics ago when I spoke of government spending against GDP, which is quite good because it set us up to discuss GDP. So if you can recall my analogy, we can think of GDP as your salary or your income coming into your home. GDP is a little bit different, but similar enough that we can use that analogy. So GDP essentially outlines how much money is coming into the country each year. And so from the graph, we can see that the yellow bar, again, represents the current government and when they took office. So although GDP seems to not have grown, it also hasn't gone into negatives, which is really important. So it has remained stable but low. And if you're looking at the graph, you may notice that there's a few orange bars that actually go down as opposed to up. Now, what those orange bars represent are quarters which have negative growth of GDP. So two of those orange bars in a row or next to each other means a recession. So there's three of those negative bars, but two happen to be next to each other, which lets us know that that was a recessionary point, which was when COVID started in 2020. Now, this is not too much of a surprise. I'm sure nobody's really taken aback by this information, but it's good to see that the GDP, although remaining low, has remained steady as well and not gone backwards. And that's a brief economic update of our Australian economy, where we're currently at in early Feb of 2025. Now, with all this being said, what I'm trying to do is paint a picture, an accurate picture of where the economy is at. Generally speaking, especially given the circumstances that the current government were under when they took over the economy, they've actually done a pretty good job. By all major metrics, they've done a pretty good job. Now, you'll see otherwise spoken on different media forms, but they've actually done quite good, and I've shown you the metrics as to why I think that. If you're watching this, you're probably asking yourself, well, hang on, I haven't spoken about the housing crisis and I haven't spoken about the cost of living crisis. We've got a great point. And I didn't speak to those points on purpose. And that's because the housing crisis and the cost of living crisis generally aren't economic metrics. What those two things are is actually a symptom. They're a symptom of wealth inequality. And now we've seen the housing crisis increase and the cost of living crisis increase both dramatically over the last few years since COVID. And that is because, as I've spoken about in earlier videos, we are seeing and have seen a dramatic increase in the wealth inequality within Australia. And that is because asset prices have continued to rise, whereas the value of money, i.e. inflation, has also continued to rise. Now it's growing at a lesser rate, but we're still in inflation. So I guess the point I'm trying to make here is that wealth inequality is exacerbated by not owning assets. So if you don't own assets, it's probably a good idea to start researching into how to purchase and what assets to purchase to increase your level of wealth and to reduce your exposure to this wealth inequality. So what I've given you here today is a quick economic snapshot of where our country is at currently. This is only talking to the economics of the country. This isn't talking about any other responsibility that the current government has to manage. I've only covered the economics. And the reason for that is I just want you to be armed with the tools so that next time when you hear something through a different media outlet, then you now have the information to decide whether what they're saying is accurate or it's slightly tarnished. Thank you again for joining myself here at Money Media, and I hope to see you on the next video. Please leave all your comments below, and I look forward to reading them all and getting back to you as soon as I can. See you.